Hey guys, welcome back. It is December 3rd, Saturday, and it's time for another weekly update for you guys, covering normal stuff, S&P 500 earnings, bond market data, some price chart data, and recapping last week's economic reports, and giving some info about the upcoming week as for economic data, right? So there's going to be a lot to cover on the economic report side that I have to delve into. So it's probably going to be a little bit longer video than I'd like it to be, or maybe even you would. But regardless of how long or short the video is, I always have bookmarks in the video description for you, so you can easily skip ahead to a different section of the video if something takes a little too long to get through, or just doesn't have an interest to you, or whatever, or maybe there's a particular area that you're especially interested in looking at. All right, so please use the bookmarks to help you, and using the bookmarks actually helps me too, because I can use the analytics to see which areas of the video are of particular interest to people. So, all right, that said, let's get to the data. All right, guys, we're going to do the usual. Start this off with the S&P 500, also known as TSP Fund earnings update. Actually summary on both S&P 500 earnings as well as the bond market stuff there. Pause the video if you need more time on this. I'm going to go kind of as quickly as I can through it. As you see, though, my price targets up at the top of the screen all went up about 5 points last week. No change to the ideal trading range. Again, this is all just based on earnings alone. Don't factor in market sentiment or geopolitics, other kind of stuff. All right, I wasn't expecting any change at all from my current value right here. The 49.25 was last week. Actually, I think that should have been a +0. So so we actually got a +2. It wasn't enough for it to round up to the nearest 5 up higher, but nonetheless, it was still a little bit of an outperformance, even if it wasn't by much. So far, we got about 95% of the index complete on earnings updates for the quarter. That would be, of course, the quarter ends at the end of December. And we've gone up 85 points on the current value since the quarter started. And looking at our percent positive growth, how much of the index is participating in the growth, it ticked up some from 57.1 to 57.7 this week. So that was pretty nice to see there. Still below what I would call the par, or the typical range of 60 to 70%, but it's not too far below it. All right, it's going to be a really slow week for earnings in December, as you see here. Only 7 companies next week, 5 more in the week of 12 through 16 December, 9 companies on the week leading up before Christmas, and a final week between Christmas and New Year won't have any companies on the schedule. That can always change. Some companies might announce early, once January starts coming into the picture. Others could report later, but very slow week. Whatever the case, only 21 companies over the next 3 weeks, and then nothing at all. Very small amount. I'm only expecting a +1 effect. So in other words, these price targets up here, don't expect them to change at all from what they're at now. At least not the current value. The expected, the forward estimates, those could change a little bit, possibly. I don't know, but definitely the current value, I'm not expecting it to move at all. Yeah, looking at bond market, we're actually both stock and bond market. Stock earnings yield for the S&P 500 remained unchanged at +2.44%. 10-year bond yield actually dropped from 3.68 to 3.51. That was on expectations of more mild inflation than was previously expected. We're going to talk some more about that on the bond yield chart when we get to that. And the 10-year versus 2-year bond yield curve inverted a little bit more, from 74 inverted to 77 basis points inverted. The average long-term bond yield, these are the bonds that have a maturity length long enough to factor into TSP's G fund growth rate. That yield came down from 3.80 to 3.63. So it is slowing there on, again, expectations for inflation to meter itself a little bit. All right, recommended stock bond mix remained at 40% stocks and 60% bonds. Those bond yields coming down actually helped that. That actually started to tick up a little bit above 40 again when it was starting to come below a little before. But as S&P 500 earnings come through more, and if we continue to see declines in the forward estimates, expect that 2.44 yield to come down a little more. And if long-term bond yields go back up, this could easily change to 35.65 or something. We'll find out. I don't know what the future holds. We're going to have to wait till we start seeing some January earnings reports really to get a really noticeable direction, though. Had only two companies in the index with $100+ billion market caps reported earnings last week. First one was Intuit, and the other one was Salesforce. Of course, they're both tech sector stocks. These were actually nice to see there because both companies beat my previous estimates for them, and both of them had earnings increases relative to the same quarter last year. And even better, look at their estimate revisions. Intuit's was mostly mixed. I think theirs was, if I remember, 2 of the 3 quarters that I had previously had data for, because one of them became, the 1 quarter out became went from 1 quarter out to becoming trailing earnings. And then second, third, and fourth quarters bumped up to 1, 2, and 3 quarters out. Well, 2 of those estimates remained unchanged. The other one only ticked down by 1 single penny. So it was pretty much a wash there. That's why I said it mixed. And then Salesforce, their revisions were mostly unchanged. They had 2 estimates, 2 quarterly estimates that were up, and the other one was down. But and it looked like a decent amount of movement on each one of those quarters too. But I don't know if I'd say which side it would really bias toward. Really, it was one that was a little more heavily down, and then 2 that were a decent up, to where I think they might have canceled each other out, perhaps. So I really say both those were kind of a wash there. And here's your complete list of companies that reported updates last week. As you see there, you got the 2 heavy hitters at the top there, Salesforce and Intuit. Salesforce being the bigger of the 2 there, along with everybody else. Salesforce is also a Dow Jones Industrial Average component, if you're interested in that index. Dollar General, I did not bother to pay enough attention to what they did, because even though they're not a very big company, there seemed to have been a trend a few weeks ago where I thought the more discount or wholesale type retailers like Dollar General and stuff that is more lower class population friendly, they seem to be doing a little bit better than let's say Target. And I just forgot to even look at how Dollar General did compared to what I previously had in there. We'll get more on there in a second there. Kroger, of course, grocery chain. Hormel Foods, these are, Hormel, I believe, is a consumer staples stock, if I'm not mistaken. All right, so that said, let's go on to the Momentum and Contrarian buy screens. There are those, 10 or so stocks, whatever it was, that reported updates last week. 4 of them actually meet the Momentum buy screen that I run. This is basically any company with double-digit earnings growth, and or in cases where the S&P 500 is performing much better than it is. Like, say, when the S&P is getting double-digit growth, I usually look for something that's at least twice the S&P 500's expected EPS growth. Salesforce, Dollar General, Intuit, and Synopsys all in there. So got a couple, those 2 larger tech stocks there, they're in there. Plus 24% EPS growth expected for Salesforce over the next year, and plus 18% for Intuit. So, that's kind of nice to see tech stocks actually doing something other than underperforming estimates and seeing larger decreases in their earnings growth expectations. Now, really, the tech sector has been more of a wash, though. Anyway, it's some have been up, some have been down as far as what I've been seeing. So I guess it shouldn't surprise me. It's just, it just kind of the trend seemed to be more on the negative side with the tech sector. And looking at the contrarian buys, those would be the ones that have negative 10% or worse EPS projections over the next year. Contrarian buys would be the ones where their stock prices are getting beaten up, and for good reason, because earnings, and you were looking for something where when the earnings decline starts to slow down and flatten out, that's a good time to start buying back in. Looking also for dollar cost average opportunities. However, this week there are no companies that meet that screen out of those 10 that we originally reported doing updates. And looking at next week's updates coming up, got 3 $100 billion plus companies. Actually, all of them are in a $200 billion plus neighborhood there. Oracle, Costco, and Broadcom. Looks like the most activity is going to be on the 7th, which I forget what day of the week that is. Perhaps it's Tuesday. I don't know. Tuesday or Wednesday, whichever way it is. I don't have my calendar up, so doesn't matter. But that'll be the most busy day there as far in a very slow week. Moving on to the bond yield curve I talked about earlier. I talked about how the long-term bond yields came down. They were previously up above 4% on that rising on that inflation problem, but as the data has been more constantly coming in now that showing evidence that inflation is metering or waning, whatever. At least we're not going to see it in the year-over-year results for several months, more than likely, but we're seeing enough month-over-month data, not just the inflation data, but in other reports to suggest that inflation is coming down, and it will continue to come down. So that's a good sign. The Fed seems to be receptive to being more dovish with their rate hike policy. They're not talking so much about doing 75 basis point rate hike this month like they previously were. It seems like there's more chatter about a 25 to 50 basis point increase. We'll get more into that one. I think some of those details in a bit later on this presentation, but yeah, we're looking good there with inflation figures. These yields coming down can be both good for the housing market because the 10-year, the 30-year yield right here, especially these three here, 10, 20, and 30, can have a greater impact on the housing market with the mortgage rates. And also, if we go into recession, a more full-bore recession with earnings and everything, lower yields here makes it easier to recover from them. So it'd be a better chance that the recession will be more mild than previous, even than it was like a month ago. All right, so looking at the short-term yields, which I always like to look at. As I mentioned there, the 30-day yield I especially pay attention to. It actually got up, if I recall, up near about 4.2% last week. Or the previous week, I mean. And so even that came down. And so that's nice to see there. Still like to see some of these left middle area yields, between the 4-month and the 1 year. Like to see those yields especially come down a little bit more. Kind of help loosen up, at least, well, not necessarily loosen up, but, just give us maybe a little bit less risk of a recession, I would say. Okay, moving on to the economic data. We're going to start with the usual weekly updates from initial and continuing jobless claims, starting with initial jobless claims here. This last week's number came in at 225. That is actually down from the previous week's 241. I normally try to get revision numbers, but I somehow did not save the information from last week, or I must have totally forgot to do the update. I don't know. But Yeah, I just updated 2 weeks worth of data here. Whatever the case, looks overall, aside from 20 November, the week of 20 November, looks very consistent as a whole between the latter part of August through now. And this is a good sign because we're mostly seeing consistency as far as probable layoff rates are concerned. We're not seeing an increase in companies laying off employees, and that's a good sign as far as odds of a recession are concerned. As the numbers start trending, continuing to trend upward, and in the wrong direction, there's a better chance that we'll start increasing the risk of recession. But mostly consistent there overall. A lot of single digits over here on the current versus the 4-week and 8-week averages. So that's a positive there overall. Like I said, it's hopefully it stays below 230. I don't expect that it will, but as long as it doesn't get like strongly into the wrong area, I'm okay with that. It'll at least help with perhaps with some of the inflation problems. And looking at the continuing jobless claims data here, this is good to look at also because it gives us a gauge of how much difficulty people who already previously filed for unemployment are, how much difficulty they're having finding new jobs. It's definitely trending in the wrong direction here. As you see when you're starting to see the colors into the more red side, it's in the wrong direction there. These numbers are up higher than what I've got there. I have to see when we last had numbers up that high. Nonetheless, though, it's kind of be expected again. Overall, again, I'm not seeing enough evidence to solidly say that there's a recession coming. It looks like we're just kind of stable or flat so far, and a little bit of an increase here is not a bad thing for controlling inflation, which is right now the elephant in the room. So let's see if the Fed can successfully get the inflation rate to trim down to where they want it, and without causing these numbers to explode in the wrong direction. And looking at the trading economics calendar there, this is last week's updates. These are the ones. This is kind of a summary of what was reported last week. I'm going to go into more detail on at least some of these in the coming slides here. We'll start with ADP employment change there. As you see here, came in much weaker than last month and was also below consensus. So this could be another case of bad news is good news as far as inflation is concerned, because wage growth drives inflation, but less employment means there's probably less wage growth going on as well, and that translates to helping bring down inflation. GDP growth rate last quarter was at 2.7%. The first month's reading last month was 2.6%. It actually went up to 2.9 on the second month reading, so actually looking stronger, like it's accelerating. So it's we'll go into a little bit more in the detail on that. I do have a lot of data you can look at when we get to that slide there. Job openings, those were also down a little bit from the previous month, just slightly above consensus, and they're expected to increase just a little bit in December. Or for November. That was the October report. Personal spending and income. These you see here, there was consensus for them to be at plus 0.8 and 0.4 respectively. They actually came in at 0.8 and 0.7 respectively. So there's more wage growth happening there than what was expected, and really it's a little too strong too. It's going to encourage inflation there. Personal spending month over month, 0.8% positive. That is also a little too strong. That's going to be an upward influence on the inflation numbers, guys. But I am saying overall, I think the inflation numbers will definitely come down. But this is going to give the Fed a little bit more reason to justify a 25 to 50 basis point rate hike when they meet up later this month. And next month's forecasts are for plus 0.6 and 0.3. ISM Manufacturing, the PMI or Purchasing Manager Index, which I like. I'm especially interested in myself. Previously was at 50.2, and it's just barely flatline, just barely above flat. And 49 is actually below. That's actually, that would be in contraction territory by a little bit. Consensus was for just a tad bit in contraction, but it was worse. When we get to that particular slide, you're going to see I don't have much positive to say about that site at all, if at all. Forecast for next month is right at flat. I'd kind of be surprised if it actually hits 50 next month myself. I don't really think it will, but I don't know. We'll see. I think it'll be lower than that, personally. And unemployment rate remained unchanged at 3.7. That was in line with consensus and expected to remain that way next month. Non-farm payrolls, they are down a little bit from last month, 284. It's down to 263 now. That was actually above consensus. Again, this is going to be one of those things that the Fed's going to look at as this could be another reason to continue with rate hike activity, because payrolls keep going up. It's going to encourage, at least promote some degree of wage growth or employer competition for workers, and which will also encourage inflation. Forecast for next month is at 210 though. So let's see if that does go continue on the wrong direction, keep going south like it is. But obviously they're expecting a little more strongly south than what they're actually getting. All right, so let's look at a little more details on these same reports. All right, this is the ADP employment data there, kind of summed up into a spreadsheet view for you guys, so you can get kind of a general idea how things look. You see here, red there, low numbers. This is the lowest number we've seen all year. We had very strong numbers in April, and I say as long as the initial jobless claims don't keep, as long as they stay consistent in that 200 to 230 range, I think we'll be okay here. This will just kind of help tamper down the wage growth and inflation data, if anything. Now, looking at a breakdown now, monthly basis, you got to be careful not to pay too much attention to the fact that some of these numbers are like the manufacturing there, minus 100,000 jobs. It's a lot of layoff activity there, more than likely. A lot of quit, retirement, layoff kind of stuff going on. But, and then it has been struggling there over the last few months, so that is a concern there. But so maybe it's a little stronger negative than we'd like to see. What's causing that, we'd have to look more into elsewhere for that information. But some of these other ones, let's see, I don't remember so like education and health services, that had 3 months of declines previously and is now, it was at plus 55,000. And looking over here also on leisure and hospitality, there were a couple of months there of declines in July and September. Very solidly positive numbers there between in the 200 to 250,000 range throughout March and June, between March and June, and we're still in that range right now between October and November. So this is evidence that people are still spending their money. They still have money to spend. When the economy is starting to go south and people are either having a harder time staying afloat or they're more concerned about losing their jobs, they start saving more of their money and spending less. And that leisure hospitality area is where that gets hit first, more often than not. So the fact that we're pretty consistently in that neighborhood there still, aside from that 3-month lull there, looks kind of pretty positive there as far as the economic outlook's concerned. Now, looking at the changes by size here, actually the smaller and mid-sized companies on the bottom end of each, as you see there, are where the most strength is. That makes me wonder if the small cap and mid cap stocks would actually be a better place to be invested right now than large caps, because I've been consistently the last couple months, since I just started doing this recently, I've been noticing the large caps have been down while Small mids have generally been up, at least on the 1 through 19 and 50 through 249 size companies. And charting out that same data there, changes in private employment. This was directly from the ADP website, or from their report there. Gives you a much better view of how things are looking. Job numbers are still growing there. We're up above the 2020 peak by a small amount, it looks like. It's starting to flatten out some, but it's still trending in the right direction. Again, we want to see employment growth, but we want to see it under control, and definitely want to see the inflation data come down first before we get much more positive out of this. And looking at the first section of the GDP report, breaking it down, as I mentioned, it was a 2.9% overall performance. I'm just going to give you a little more of a breakdown. Just go ahead and use your pause button if you want to scrutinize this data a little bit more here. So I'm just going to give you an idea of what you're looking at, though, first. So 2022 quarter 2 right here was the final GDP result from second quarter. And right now we're working third quarter. This was the first month's reading. This is the second month's reading. These are not final for the quarter. It's just so you can kind of compare what's going on between the previous quarters and what's going on during the current quarter. So you might want to compare these two numbers against this number here. Like say the 724 as far as motor vehicles were concerned, they're trending downward, as you see. Now another reason you might want to look at this stuff too is if you're investing in individual company stocks. If you're investing outside of TSP, or even if you're investing in the mutual fund window on TSP, these can give you some ideas on where the consumer demand is. And where the consumer demand is where you might see better performance for your purchase shares. So right now, let's say motor vehicles and parts is trending in the wrong direction since first quarter. You might not have so much interest in buying stocks in that category, but you might see something else here like furnishings and durable household equipment there. That's trending upward. Even the second month reading this quarter is above the first month's reading the previous month. And so this is where this data can actually be useful to you. Recreational goods and vehicles, again, consumers have money to spend. They won't be going upward with recreational equipment and vehicles if they don't have money to spend. So there are some positive things that can be taken away from this. And I mentioned that the GDP is accelerating. So that's another reason why we're kind of starting to see the stock market reverse its trend from a downtrend to an uptrend as well. All right, from that, I'm going to go ahead and move on, though. I have like 3 pages of this GDP data that will be available for you to review. Just hit the pause button if you need time on them. I'm not going to go digging through each one. Just know that, so we got the personal consumption expenditures here. This is goods and services. And page 2, looking at the next category will be gross private domestic investment. Got fixed investment, non-residential, unresidential stuff here. And then change in private inventories as well. So non-farm inventories are going up, but farm inventories are going down. Otherwise, just hit the pause button if you want some more time on this. I'm going to go ahead and skip ahead, though, otherwise. And the final page of the GDP update here, net exports of goods and services. Exports overall are trending upward. That's actually good. That's positive for GDP. And imports, as you see there, are trending downward. That's also a positive for GDP. Imports are down from last month. And also down from last quarter. It's a negative trend there. So it's again, these are all looking positive. It's good for U.S. economy. Maybe not so great for foreign economies, but of course we're naturally concerned about our own economy first. And the last category here, government consumption expenditures, gross investment. We've got federal and state and local stuff here. State and local actually seems to be where more of the strength is, or at least definitely a lot of the focus is in terms of raw dollars spent. There is growth here on the federal side too, though. Again, though, if you want to scrutinize this more, go ahead and hit your pause button now, because I'm going to move on to the next area. Looking at the job openings data here, as we call it, JOLTS data. So we've been in a downtrend overall. They're kind of down. The August, September, and October have all been down compared to what we saw earlier in the year. Again, that's a positive when we have an elephant in the room called inflation that needs to come down. So as this job openings data comes down, we should see this ratio of job openings to jobless numbers come down as well. Now, there is natural volatility in here because there were 5 weeks that were factored in October. So the actual number for October is probably going to be lower than what you see there. And that means the ratio as well is going to be higher. I don't know that it would actually necessarily be, I would expect it would be maybe maybe 1.5 million or so lower, if at most. So it would probably be in the same ballpark with these on a month-to-month smoothed out basis for 5,500-ish, 6,000, I don't know, somewhere in that neighborhood, I would have to guess. So I would expect the ratio to be up a little higher than that. But again, let's see how things go as we progress. This is a good thing, though, for at least, like I said, this means that it's not so much competitive, so much competition for between employers to hire and keep their employees. Now it's going the other way, where employees have more of a reason to stay in their current jobs and not keep job hopping. All right, and I'll give you a breakdown here as well, where the strengths and weaknesses are at that were reported. Local government, excluding education, was down 101,000. Non-durable goods were down 95,000. Federal government down 61,000. Other services up 76,000, and finance and insurance are up 70,000. So finance and insurance, particularly, I don't know how much of that broke down into either side. I could have gotten the data, but I wasn't concerned about it. But insurance, you kind of wonder how much play that would have with natural disaster stuff going on there. All right, moving on though. Just give you a quick little read here on the personal spending data. I mentioned previously it was at plus 0.8 month over month. These are a little too strong, I think. I think they should be down a little. Like I mentioned, 0.2 to 0.4 is what I would think would be a nice range to see for keeping inflation where we like to see it. So, and it looks like it might start going in the wrong direction, as more strong, which is that's a good thing, but it's also going to again encourage the Fed to continue with some more rate hikes in the future. And personal income, see that accelerated to 0.7% this last month. We were in that nice 0.3 to 0.4 range the 2 previous months, right in that area where I told you I like to see it. Most of the year been at 0.05, maybe just a little too elevated, but not far off. 0.7 is a little more of a concern, and that is going to be a little more of an inflation concern as well. So again, that's going to encourage another rate hike by the Fed. And now for the one that I call the ever important ISM Purchasing Manager Index, or manufacturing report. I translate the raw numbers from the report into numbers that are a little bit easier for the layman to understand. 50 or 60 versus 40 don't mean anything to the average investor. They don't know what does that exactly mean. So I think positive and negative numbers are easier for an average person who's just learning about economic analysis to understand. So you see here, though, the overall trend is the overall consensus is slightly in contraction neighborhood, minus 1%, or it's really 49 on the report, like I mentioned on the summary. New orders, those are down 3 months in a row now, and 5 out of the last 6 months. So again, it's a little more strongly down 2 of the last 3 months than the rest of that 6-month period. So that's a little concerning. That could elevate the risk of recession, because it could lead to layoffs, and more layoffs could mean more people out of work and demand actually going down. We don't want to see inflation get controlled by declining demand. We want to see it controlled by, freeing up supply bottlenecks that are causing, it to take too long for people to get what they're trying to buy. Or just to achieve better supply versus demand balance. All right, let's see. Employment down. These are generally, I don't really pay as much attention there, but you see during the pandemic, though, they were way negative there. Even coming out of the pandemic, there were still some negatives in there before it turned positive. So it's not necessarily a bad thing, but as long as we're seeing single-digit numbers here in either direction, I'm okay with that personally right now. Yeah, again, let's get the inflation situation sorted out first, and then once inflation issue is resolved, I'd like to see this start turning positive again, but not go too strongly positive like maybe in March of 2021. Supplier deliveries they turned south. They were up very strongly, as you saw there in May of 2021 as well. Had a downtrend there. We're mildly positive in September, but the last 2 months are negative. So it's not really a good sign there. Inventories. Now, this is actually not, well, there's more to this that we can't get from this data itself. But inventory is going down, actually more flat now from a positive trend earlier in the year. Not really a bad thing because that means what inventory exists is getting bought. It's just a matter of what inventory exists, it might not be getting replaced by new inventory. This is on the upstream side. So not really sure what to gather from that just yet. Customer inventories, this is actually looking better per se, but in another way, it's not necessarily. This is good for controlling inflation. However, customer inventories or downstream inventories going on the increase also means that demand is, there's more supply than there is demand, and it's trending in the wrong direction. So, and it was a very sharp change between the September and October numbers and the November result. I have a really good suspicion that next month customer inventories number is going to be up above 50, or a positive number range here on my report. Again, we don't want to see it accelerate. If it's one thing to come down, but do it at a more like a controlled pace. When it's sudden like that, that tells you more that there's probably a better supply of goods available that they're not selling. Demand is down. So prices, more evidence that inflation is coming down. We're down into the negatives the last 2 months here on the manufacturing side of the economy. Manufacturing accounts for about 30% of the broader U.S. economy, by the way. So again, this is actually good, but do we really want to see deflation going on there? I'd be a little more. That's also something to be concerned about. But because too much deflation there is also going to encourage companies to cut costs by cutting staff. So again, that's a concern. Backlog of orders. We had a large backlog of orders back in around the middle of 2021, and it's shrunk down some. And now it's down in contraction territory. So the backlogs are shrinking. That's not good, especially when the inventories are, we're already seeing that inventories are going up. Available inventories are going up, but backlogs are going in the wrong direction. Again, that's all evidence of too much drop in supply and not enough increase too much drop in demand and not enough of it from increases in supply. New export orders, they are down 4 months for the fourth time in a row. At least there's some stability there, but again, new export orders though, we saw in the GDP data, exports are up, but all that export activity is more focused on the services side of the economy. We still want to see some stability on the manufacturing side again. Don't want to see people getting laid off from their manufacturing sector jobs. Import activity, as you see, is down. So it pretty much echoes what we were talking about in the GDP data. And positive breadth out of the 18 industries within the manufacturing sector, only 6 of them were reporting expansion. That's the worst number I've seen since May of 2020, when we were at the very end of the pandemic. This data here is what you call the EAFE PMI data. EAFE would be EAFE, or Europe, Australasia, and Far East. These are the countries that have companies representing them in the ETF, the MSCI EAFE index. That same index is what the ETF EAFE. I know there's a lot of acronyms here, guys. Sorry about that. The ETF that invests in the TSP's I fund. That would be what's involved here. You don't see China in there, do you? That's because they're not part of it. These countries do have companies in that index, though, and those are the ones we're mostly concerned about for international stock fund indicators. Overall, now there's kind of some back and forth here from what I'm seeing overall from one country to another. It's I gotta kind of use those loosely together. Some of these look like a lot of them are in contraction territory now. Looks like Norway is still in expansion territory, but they're down from the previous month. And Switzerland is also in expansion territory, but they're trending in the wrong direction. Now, those are the only 2 countries that have reported so far PMI data for the month of November that are even in expansion territory at all. All of the others are in contraction. Now, contraction territory here means probably not good news for their respective economies. And if they have bad news for their respective economies, there's less tendency for them to put demand on the U.S. economy for exports, which is going to bring down our GDP data and slow down our economy. So we depend on each other there. I'd like to see a little bit better, some increases going on there. I believe I did see some, like this one here, France. They actually accelerated a little bit. They were down 2 months in a row, but it looked like they're going back in the right direction. Who's that? Italy? Yeah, I believe Italy. They were down briefly, but they're still they're right back in that same area where they were at the 3 prior months to that. So that's a positive sign. Mostly steady over here, but just a tad on the contraction side in Singapore. This is just a 1 month thing here in Spain. I don't know if that's going to start a trend or not. It could just be a brief increase. That's about it to report there as far as positivity is concerned, in the reversal in the direction there. Looking at unemployment rate data here, we talked about how 3.7's been what it's been 3 of the last 4 months here, as you see, and it's been in that 3.5 to 3.7 range ever since March. So a lot of consistency there, but it did tick up a little bit, as you saw in August. At least there's stability there. Again, that means there's evidence there that it is possible, perhaps, for the Fed to achieve a soft or softish kind of landing, just like they're talking about in their the regular updates. Let's just hope it stays in that neighborhood. I think they were expecting it to climb back up into the 4s, though, as they continue to try to rein in inflation. We'll see how it goes. So a little bit of an increase might not be too bad. Just don't want to see it trend very too strongly in that direction. Yeah, looking at the non-farm payrolls data here, you see that is a lot of red there. I just barely started keeping this data here, so of course it's going to look more red there as far as just a 12-month picture that I'm looking at here is concerned. As I get longer-term historical data in this sheet here, the colors on that column there will help give you a better idea just how strong or weak it really is over time. But again, This is with the inflation situation being the elephant in the room. It's not a bad thing that they're coming down, especially if the unemployment rate keeps staying at 3.7. And looking where the strength is, again, leisure and hospitality is where the strength is at. Healthcare is also seeing strength, 45,000 jobs there. Government, 42,000 job increases, or payrolls, whatever. But retail trade is down 30,000, or well, 30 million, whatever you want to call it, or 30,000 payrolls, and that is a little bit of a concern. In the short term, that makes me wonder if the consumer focus might start shifting to some other area outside of retail now. And transportation and warehousing is down negative 15,000. Again, don't really want to see supply chain stuff getting beat up like that. It's not strongly negative, of course, but it's nonetheless in the wrong direction. But yeah, as demand is dropping here, I can't say I'm too surprised to see this information here. And looking at the whalewisdom.com sell versus buy data here, this is actually looking more promising here. I had mentioned at one point in time that some of these numbers were a little bit more elevated, closer to the red line, the bear line. But yeah, in November, they've been trending more toward the bullish side, and it actually just crossed into bull territory this week. And DAT, truckload freight rate stuff. This is a big concern there. Spot load posts hugely down. However, this was not really a surprise either because it was the week of Thanksgiving. A lot of warehousing companies were closed for the holiday. Like a good example, Walmart. I had a load that was supposed to deliver at a Walmart distribution center on Thanksgiving, early in the morning on Thanksgiving, but I could not deliver that load until Friday because the DC I was delivering it to was closed on Thursday. So not really a surprise there. It's on both the shipping and receiving side there. There was just not freight going out, and that would be a large reason why you have such a large drop, both on the spot load post and the truck post as well. So we'll revisit this when we don't have holidays interfering with the weekly data. We can't work with next week's data either so much because it's going to be comparing to Thanksgiving week, and this kind of should be an expectation for an uptick in activity, especially with us leading into Christmas and people doing more shopping and stuff. And breaking down the freight rate and fuel price data here, van freight actually went up. Good 11 cents per mile there this last week. That's a nice little jump there. But I think that's, again, holiday gift demand, I think. Stuff going out, working its way through the supply system and going to end up in the stores so people can do their last-minute Christmas shopping, I assume. Meanwhile, the flatbed and reefer rates both dropped a little bit more. Again, that's not a good thing we want to see. However, on the reefer side, we're still up above the 6 November result of 273. So, like to see stability there for now. At least if we see some stability here, especially in the flatbed, that'll be, I think, more of a sign that we could be flattening out with economic growth. Or instead of declining, or seeing evidence of risk of recession. More flatness here would give us more reason to be optimistic, at least, or at least relieved that we're not in perhaps such a high risk of a recession then. And rounding out this week's update, we have the next week's economic calendar. Monday will be the ISM Non-Manufacturing Index. That says PMI, but technically it's NMI, Non-Manufacturing Index. It's also otherwise known as the Services Sector Report. Again, it's just like the Manufacturing Index report that I just gave you in this update here. A lot of good information in there. They're expecting to slow down a little bit. Not by a lot, but it's supposed to be a little bit slower than last month. And forecast for December is also going to be at 53. So Look like kind of a steady growth is what they're expecting. We'll see if we actually get it though. All right, Tuesday we got balance of trade coming up. The previous result was a deficit of 73.3 billion. Consensus is actually for the deficit to widen to minus 79.1 billion. But for December, forecast is for it to get right back to minus 73 billion. So I don't know. Maybe there's some potential for the balance of trade to go more favorably than that, especially with GDP data, showing evidence of increases in exports and decreases in imports. This could actually go in the right way. However, balance of trade, we got to also factor in the value of the U.S. dollar relative to foreign currencies, and with the U.S. dollar, the dollar index being on a decline lately, this isn't a huge surprise also. So trade might be kind of balanced perhaps, and maybe that a lot of what this consensus will be is just because the dollar declining in value. Which speaking of that, we're going to go to the stock charts and stuff. Let's cover the S&P 500, crude oil prices, and the dollar index like I usually do, and then we'll conclude this. All right, let's start with on the charts with S&P futures daily chart. Again, I like to look at S&P futures, not the S&P 500, primarily because I can get volume data here off the S&P futures chart. We did have a lull in volume in the previous week, but it ticked back up. Not heavy like there was here at the bottom here, but it was on the heavier side, I would say. So that's a positive. And there was an increase there that was associated with it. As you see there, this larger green candlestick here came on heavier volume. Again, not as heavy as some of the strong days we've seen in the past, but it's still it's a good sign there. Now, technically, though, we do have kind of mixed situation there as far as we can possibly expect the price to reverse back downward, or we might actually see some support in the near future. Let's go ahead and start right there. All right, so as you saw here, the price made it up to the very top of this same price channel that was already there previously, and it seems to be finding resistance at that channel. However, it just crossed over the 200-day average as well, and now we got the question: is it going to a head fake, where or as you might call it, where it comes up above the 200-day to kind of fake people out, because there might be people with maybe a large number of buy-side orders right there, but it could be some more sell-side orders just above, because maybe people are already out and expecting or actually expecting a drop, so they could sell on the either whether the profit take or short sell, whatever. But we got a nice bounce there off the 10-day moving average there too. So that's a good positive sign there. There's a better chance, I would say, especially with the 200-day, we might see it kind of hover in the area. Maybe stay in the area of the 200-day average for perhaps like three full tests of it before it actually moves back in the upward direction. Let's see, I didn't extend this. Let me extend this. Okay, yeah, see again there, it's bouncing right off the top end of two different price channels. Let me extend this one as well. So right now, looks like a possible point of support if the 200-day doesn't hold would be the 10-day still at 40.18. Got the 100-day here at 39.34, and the price channel here, the bottom end of it, right at 3,900. Or down at 38.23 would be the 50-day average. So definitely some signs of possible support there at the very least, where there's definitely at least some evidence of a trend reversal there. So let's see if it continues. Let's move on to the weekly. All right. Again, here's the numbers. The chart's going to look pretty much the same, but the moving averages are where things differ. Um, Again, we still have these same price channels here that you saw on the daily chart there. We have a little bit more room to get to before we get to the 50 and 100 week averages. You see the 200 week average is way down here at 36.43. We actually bounced off it very solidly in October and seem to be in an uptrend now, so that's actually a positive there. Now, well, question is though, will it bounce? Will I find resistance off of one of these trend ceilings here, or will we continue our way up to 41.35 where the 50-day average, 50-week average is, or even maybe even continue up closer to 4,200, 41.96 to be more precise, where the 100-week average is. I think there's potential for it to make it up past the channel. I think this trend channel, I think, can get broken through possibly, but in the meantime, I wouldn't be surprised if this shorter term channel holds true. So with that said, I wouldn't be surprised with if the price either goes sideways or maybe a little bit down over the next week. Maybe as this this is a more sharp upward channel here, by the way. So it won't take much more than maybe a couple of weeks for it to come down and hit the bottom end of that price channel and find a possible support again. So yeah, it doesn't look like the downside risk is as high as it might seem. 39. Yeah, I had just bought futures contracts not too long, like a couple of weeks ago at 39.16. So, and that is right here in that same area where where the channel's at now. So, that's actually looking good there. All right, and now let's look at the crude oil price chart here. It's the daily again. Previously, I had reported there was a lot of stability somewhere in the 85 to 90 range, as you saw it throughout here, right in that area. It actually got down a little bit lower here, down to just below 75. Look like on an intraday basis, the low was 73.60, but it closed at 76.54. It's trending back upward now, but waning demand and other things that have come out recently, I'm apt to believe that this probably won't get much higher. It's already looking like, but well, and again, coming up above the 10-day average and looking like it's coming back down could be a sign that it might be trying to test the 10-day average for support before continuing back up. Or it could be a head fake and come back down. We don't know that, but just kind of give you an idea. 80.34 is where it closed for the week. That was up above last week, so with that, I would expect the price of gas and fuel to possibly increase just a little bit. Maybe back up above, like I mentioned, the price of diesel was down to $5.14 this last week. I wouldn't be surprised if it comes back up in the 520s or something like that. If it holds, if it stays in line with what the crude oil price market is doing there, at least. And looking at the weekly, same thing here. Actually, we're in a downtrend there, and it's got down below the 100-week average, and it looks like it found resistance there too. So, or at least might be finding resistance both there and a 10-week average. So, that could be at least on a technical level. Could be more sign that we could see some dropping down here. I have heard stuff about I think the price for Russian crude oil, that they were going to set it around, try to target around $60 a barrel or something like that for that. So maybe we'll see the same thing on the U.S. Oil market, and that would be some relief on the fuel and gas prices. It'll also be some relief on inflation, not core inflation, but in regular overall inflation, and may also help with keeping the unemployment numbers under control as well, not letting them get out of control going too much north. Maybe keep them stable or even moving back in the right direction slightly. All right, looking at the final chart for the day, actually the last two here, the daily part first for the day for the dollar index. Definitely in a decline, downtrend lately, and it actually got down below the 200-day average this week on Thursday and Friday. So, or Wednesday and Friday, I think, because I don't actually, no, futures market was open on Thursday. I remember watching it. Yeah. Okay. Well, yeah, it got down below the 200, so that's more evidence that we could actually even get lower. I did talk about how in the previous updates, seeing this number come down, this value come down will actually encourage U.S. exports, which is good for U.S. Economy as well, good for U.S. jobs, and but now and then the dollar index also going down is going to be a good sign for that MSCI EAFE index as well, because or actually more so the TSP's I fund potentially, because the I fund invests both in that ETF, that I was talking about, but it also invests in the foreign currencies of those countries that you saw in that report that I talked about earlier in this presentation. When that happens, then it means the value of those foreign currencies goes up relative to the dollar, and it makes it easier for them to put demand on the U.S. economy, and it might can stimulate our own economic strength too. So it's not a bad thing that we're we got too far out of the sweet spot, as I call it, over here in this area, but we're getting back into the sweet spot now. This is the way I'm kind of looking at this. And looking at the weekly chart there, you just saw there was a huge drop there in the week of November 7. That was because of that weaker than expected inflation report that I had previously mentioned was actually above my own expectations, but was better than what the experts' consensus were. I was expecting again 7.5 when that happened, and they were expecting 7.9, and they got 7.7. All right, now looking at the technicals here, though, we have some possible support here at the 103.67 level. We closed at 104.506, I believe it says. So we might find some support over here. And there is a bit of a gap there between the 10 and 50 week averages there. So, but that could be another argument for having this number come down and stay down a little bit more, and let the 10-week average work its way down a little bit more and tighten these averages up too. All right, and then the 100 and 200 week averages are down at 97 and 98. So I don't know, perhaps, I think 100-ish, maybe give or take a little bit in either direction from 100 would be a nice area. I think I'd like to see it get to. Don't want to see it get too far down, but at the same time, don't want to see it stay elevated very long either, because they mentioned there that we need demand, and we're seeing too much softening demand in the data. Well, that's going to be a wrap up for this week's update for you. All right, so a couple of takeaways here. I'm a little concerned about the demand dropping too much, and that's going to help accelerate the inflation decline, the slowdown in inflation, but in the wrong way, I think. I'd much rather see some supply chain bottlenecks get freed up and keep demand going in the right direction. Like I said, it was negative. It just did not look good at all on the ISM Manufacturing data overall there. I hope the ISM Services report coming out Monday will be a little bit better, or give at least some more positivity. But it's looking definitely concerning to me. But they're all, like I mentioned, though, there are also some positives to take away there. Dollar index value coming down is going to help U.S. exports. GDP is going up. On GDP data is even showing an increase in export and decline in import activity. So that's a positive. Trends looking more short-term positive overall, I'd say, on the stock index, S&P. I do expect a short-term decline or flatness in price over the next week or two before possibly bouncing back upward for right before Christmas, Santa Claus rally, perhaps. We'll see. So that's basically what I talked about if you didn't see all that data there. Also, Jerry Horan on his Grow My Thrift Savings Plan or Grow My TSP Facebook page, because he and I, Conan, his producer, and we had done a interview. It was roughly an hour long, I'd say, on his for his page and channel, whatever, YouTube. I think he also puts it on. It'd been a couple weeks ago. I thought he was going to post it last weekend, but it didn't end up happening. But yesterday he had posted on his page that he was going to have that interview available for viewers to watch tomorrow, Sunday. So if you like to always hear what kind of insights I have into anything like economics or some other stuff. Some of it will be just kind of regurgitating things that you're already hearing here on my channel. Might be a little bit of new content there as well that I haven't talked about here on this channel. So check it out. Go to his page, check it out. And then also he does cover a lot more of the chart technical data. If you want to educate yourself more on the chart stuff, you can always check him out as well. Check out his presentations, because I don't go very far into the technical for reason I can't do it. I'm a lot more interested in the fundamentals. So I'd just rather devote my time to the fundamental data and the economics and stuff than and let people who are more focused on the technical aspects of investing to do their chart work. All right, so that said, I hope you guys all got a lot of great information out of this. Please use this information, make your own decisions, whatever they happen to be. The best you can do, all right? So do everything you can good for yourself, and we'll try to keep steering you in the right direction, but we won't always be right. Just try to give you the data and just raw data, and you get your own impressions from what you're seeing, though, is what I'm really hoping you take away from this. Okay. So that said, I'm in Memphis right now. Hopefully be out of here soon. I'm already empty, and all right, so we'll probably see you next week on next week's update, right? If I don't see some of your comments on my interview with Jerry and his post tomorrow. Okay, y'all have a great day. We'll see you then.